If you are collecting Social Security right now, pay attention because three money changes are affecting seniors this summer, and each one touches money that is already yours. Do not assume these changes only matter to people in financial trouble. Even seniors with steady retirement income can miss a payment update, overlook a deduction, or pay more than necessary for medication simply because nobody explained the rules clearly. The goal here is not to create panic. It is to make sure you know what to check and who to contact. One can disrupt how your monthly benefit reaches you. One can shield thousands of dollars from federal taxes. And one puts a hard ceiling on what you pay for covered prescriptions in 2026. These are real changes involving your deposit, your tax return, and your medicine cabinet. More importantly, each one comes with a specific action you may need to take. Taking a few minutes now could prevent delays, reduce taxes, or make expensive prescriptions easier to manage. The first change affects how Social Security payments are delivered. The second is a new federal tax deduction for older Americans. The third limits annual out-of-pocket costs for Medicare Part D drugs. Let's go through all three in plain English. Change number 1. Paper Social Security checks are going away. This is the most urgent change because it involves how your monthly payment reaches you. Executive Order 14,247, signed in March 2025, directed the federal government to move away from paper checks and toward electronic payments. Social Security has continued that transition, with the agency moving beneficiaries toward electronic payment during 2026. If your Social Security already arrives by direct deposit, nothing changes for you. But if you still receive a paper check in the mail, or you know someone who does, now is the time to act. A payment that does not have an electronic destination may be delayed while the agency tries to move the recipient to another payment method. Many people still receiving paper checks are among the oldest beneficiaries. Some have used the same system for decades, do not bank online, or do not have a traditional bank account. It is important not to exaggerate this change. Social Security has said beneficiaries will not simply lose their benefits because they were slow to respond. The agency has also indicated that exceptions may remain for people over 90 and for those who genuinely cannot use electronic payments. This is a change in how your benefit is delivered. It is not a reduction in your benefit. Still, waiting until a payment is delayed is not a good plan. You have two main options. The first is direct deposit into a checking or savings account. To set it up, you normally need your bank's routing number and your account number. You can update your payment information through a My Social Security account, call Social Security at 1-800-772-1213, or ask your bank for help. The second option is for people without a bank account. It is called the Direct Express card. This is a prepaid debit card that receives your federal benefit automatically each month. You can request one through godirect.gov or by calling 1-800-9676-857. There is also a hardship waiver for people who truly cannot use electronic payment. The Treasury number is 1-855-290-1545. This option is intended for genuine hardship, such as having no practical access to banking services. Electronic payment also reduces the risk of a check being lost, stolen, or altered in the mail. If you still receive a paper Social Security check, make the switch before there is a problem. Change number 2. The new senior tax deduction. This change could reduce the amount of income subject to federal tax. The 2025 federal tax law created an additional deduction worth up to $6,000 for eligible Americans age 65 and older. It can be claimed on top of the regular standard deduction. The amount is per eligible person. That means a married couple could potentially deduct up to $12,000 if both spouses are at least 65 and meet the other requirements. You do not have to itemize deductions to claim it. You can take the normal standard deduction and add this senior deduction on top. However, there are income limits. The full deduction is available to eligible seniors with modified adjusted gross income of up to $75,000 for a single filer or $150,000 for a married couple filing jointly. The deduction begins to shrink above those levels. It disappears completely at $175,000 for single filers and $250,000 for married couples filing jointly. Two details are especially important. First, married couples generally need to file jointly to claim it. Second, the income calculation can include more than Social Security. IRA withdrawals, interest, dividends, and gains from selling property can all affect eligibility. A large one-time retirement account withdrawal could push your income above the limit and reduce the deduction. In some situations, spreading a withdrawal over more than one tax year may help, but discuss that decision with a qualified tax professional before acting. To claim the deduction, it is reported on the new Schedule 1A and then carried to Form 1040 or Form 1040-SR. If you use a tax preparer, ask directly whether the senior deduction was included. If you prepare your own return, make sure the software has your correct age and filing status. The deduction is available for tax years 2025 through 2028. If you already filed a return for a year in which you qualified but did not claim the deduction, you may be able to amend that return using Form 1040-X. Remember, this is not the same as eliminating federal tax on Social Security benefits. The law created an additional deduction. It did not automatically make every senior's Social Security tax-free. Some low-income seniors may receive little or no benefit because they already owe no federal income tax. Higher-income seniors may receive a reduced deduction or none at all. The value depends on your own income, filing status, and tax situation. Change number 3. Medicare Part D prescription costs now have an annual ceiling. For many years, Medicare drug coverage did not provide a clear maximum on what beneficiaries could pay out of pocket for covered prescriptions. For 2026, out-of-pocket spending on covered Medicare Part D drugs is capped at $2,100 for the year. Once your qualifying spending reaches that limit, your plan covers 100% of the cost of your covered Part D drugs for the rest of the calendar year. For someone paying hundreds of dollars every month for medication, this cap can make a major difference. Your deductible, co-payments, and co-insurance for covered Part D drugs count toward the limit. However, your monthly Part D premium does not count. Drugs covered under Medicare Part B, including many medications given by infusion in a medical setting, generally do not count toward the Part D cap either. Check whether each expensive medication is covered under Part D or Part B so you understand which costs move you toward the limit. There are also two programs that may help. The first is Extra Help, also called the Low-Income Subsidy. This federal program can reduce Part D premiums, deductibles, and copayments. You can apply through Social Security using Form SSA-1020 through the Social Security website or by calling 1-800-77-21213. Do not assume you earn too much based on an application from years ago. Eligibility rules and limits can change, and people who were previously denied may now qualify. Applying is the only reliable way to find out. The second option is the Medicare Prescription Payment Plan. This program allows you to spread your out-of-pocket drug costs across monthly payments instead of paying a large amount early in the year. It does not reduce the total cost. It only changes when you pay it. For people with expensive prescriptions at the beginning of the year, that can make the cost easier to manage. Let's recap. First, paper Social Security checks are being phased out. If you still receive one, move to direct deposit or a Direct Express card before your payment is delayed. Second, eligible seniors may claim an additional deduction of up to $6,000 per person. Make sure it appears on your return, and consider whether an amended return is appropriate if it was missed. Third, out-of-pocket costs for covered Medicare Part D drugs are capped at $2,100 in 2026. If medication costs are difficult to manage, apply for extra help and ask your plan about the Medicare Prescription Payment Plan. Your deposit, your tax return, and your prescriptions. This video is for general education and is not personal legal, tax, or financial advice. Confirm your own situation with Social Security, Medicare, the IRS, or a qualified advisor before making financial decisions. If this helped, share it with someone over 65. They may not have heard about these changes yet.